Last week, a small rate hike of 0.25% was announced by Fed at their two-day meeting on March 22nd. It is the second rate hike so far in 2023 and also the ninth hike since March 2022. The 25 basis point hike brings the federal funds rate to 4.75% to 5%, in line with December estimate. However, even a 0.25% rate hike has been achieved a new historical high level since September 2007. It is obviously that the recent banking crisis has really slowed down the interest rate hike. In the early March, Powell was still saying that Fed would be very likely to increase 0.5% in March meeting, according to the inflation data, but actually they only increased 0.25%, which seems that the Fed still takes into consideration for the risks in the financial markets. If Fed continued to raise the interest rate, it would cause more banks collapse. But without raising the interest rate, inflation cannot be controlled, and investors can also suspect that the Fed is worried about the subsequent impact of the banking storm, which will lead to market panic. So raising interest rate by just 0.25% could be a suitable compromise. A small rate hike would reduce inflation slightly without making the financial markets too volatile. At the end of the March rate hike meeting, Powell also hinted that the rate hike could end sooner than previously expected. This opinion was widely reported by a large number of news media last week, saying that the interest rate hike was nearing its end. But we are here to remind every investor that it is better not to be happy too early. It would be a mistake to take what the Fed say, since the Fed said that the meeting that the financial markets remained stable, and he stressed out that the US banking system is pretty steady. However, a new study shows that nearly 190 banks may face the fate of Silicon Valley Bank. So the banking crisis in 2023 still exists and the financial risk cannot be ignored. Economists have also suggested that as the FDIC's deposit insurance fund begins to suffer losses, that is, these banks may even pose a potential risk to insured depositors with bank balances of $250,000 or less. What is more, on the same day with the Fed announced the rate hike, Treasury Secretary Janet Yellen said that after the collapse of Silicon Valley Bank, the Treasury Department would not consider any plan to guarantee all bank deposits without Congress approval. In other words, the funds that everyone puts in the bank cannot be fully guaranteed. Although Powell also hinted that the rate hike may end sooner than previously expected, he also said that the inflation war is far from over, and the central bank stressed that its top priority remains to curb consumer price increases, adding that the Fed remains highly concerned about inflation risks. Also on Wednesday meeting, the Fed said it expected the economy to grow by 0.4% in 2023, slightly below its December forecast of 0.5%. This is based on median forecasts from policymakers. Fed officials just forecast a growth of 1.2% in 2024, down from their previous forecast of 1.6%. Many economists are less optimistic, expecting the Fed's interest rate hikes and banking storming to trigger a recession this year. By the end of this year, the unemployment rate of 3.6% will rise to 4.5%, slightly lower than their previously forecast of 4.6%. In this background, if the Fed pulls interest rate hikes, it will boost stocks and lower corporate borrowing costs to boost the economy, which officials have been trying to weaken the curb inflation. But we think a pause in rate hikes is more likely the Fed is concerning about instability in the banking system, potentially lowering investors' confidence. At the March rate hike meeting, most Fed officials hinted that they would stop raising rate at the terminal rate 5.1%. So many media reports showed that the Fed would stop raising rates in 2023 and even cutting rates from 2022 to 2025. After all, recent banking storms hit the confidence of investors that a great recession is coming. For example, you may hear the big news that Deutsche Bank, Germany's largest bank, its stock price has fallen sharply for the consecutive 3 days and once plunged 15%. Since the collapse of the Silicon Valley Bank in the United States earlier this month, Credit Suisse was forced to be bought by UBS, and then Deutsche Bank's share price fell within days. The series of instability showed that investors' concerns about the entire banking system. If we look at historical data, it usually takes about 3 years to reduce inflation down from its highest level. The historic period that is very similar to our tough rate hike and inflation reduction is around 1979 and 1980, which is the famous Walker moment. In 1979, rising global oil prices, rising labor costs, fiscal deficits, and rising commodity prices, all of the factors caused the inflation rate to soar to 14.8%. Then in 1980, Walker became the Fed's president, and he sharply tightened monetary policy and raised interest rate, which took 3 to 4 years to bring the inflation down. But our current high inflation after the COVID-19 pandemic also soared to 9.1% in June 2022, which is not as high as in 1980s. Therefore, we speculate that based on historic data, that it may take about 2 to 3 years for the Fed to bring the inflation down this time. Starting from March 2022 to raise interest rate, it will take at least to 2024 to bring inflation back to a normal level. At this time, the rate hike meeting, the Fed's preferred annual inflation measure is now expected to fall from 5.4% in January to 3.3% at the end of the year, up from an earlier estimate of 3.1%. Inflation is expected to fall to 2.5% next year. It is clear inflation target that the Federal Reserve gave everyone with the confidence. However, the Biden government is secretly doing some stuff. We just talked about economists' prediction of a recession this year. So in order to prevent a great recession, the Biden government is secretly sending money again. Congress announced a huge $1.7 trillion funding bill at the end of 2022, and the Biden signed this $1.7 trillion government bill on December 29th for fiscal expenditure in 2023. Also, for recently protecting the banking sector, and there's another 4.4 billion was released to putting aside in case any bank that file bankruptcy again. So with all these 1.7 trillion, the expenditure that's going to spend in 2023, also with this 4.4 billion that putting aside, which is printing money again, these all seems kind of like reasonable for US development. But in fact, Biden government was afraid that the bad economic data during his tenure. As the Fed has raised interest rate for the 9th time since March 2022, US economy has been dragged down seriously. So in our opinion, in order to save the economy, the government quietly approved fiscal expenditures and those money that for saving the banking sectors, hoping to achieve a soft landing for the economy. But the most fatal problem is that there is more money circulating in the market again, which will increase the CPI and forming a vicious circle for the inflation. Due to the recent unstable financial market, investors' confidence in the banking industry has decreased a lot. Then in addition to buying safe to store cash, the rest of the money will still be invested in real estate. This will make the housing market, the price rise again. We all know the housing cost which is the shelter price, is one of the most important part of the CPI, which counts 1/3 of the CPI. So if we make the real estate market hot again, then the shelter price will follow, and then the inflation will not come down that easily. Since the COVID in 2020, the government has crazily sent print money. Inflation soared because of the printing money. Then the Russian and Ukraine war began in 2021, and now there have been 9 consecutive interest rate hikes. This series of situations has not been seen in decades. Therefore, we can only wait to see whether the economy could achieve a soft landing or it may crash sometimes sooner. We have always committed to provide the latest financial and housing market data so that everyone who can get the first-hand information, and hopefully whoever watching our channel will combine our analysis and your own rational decision to find a great opportunity to invest. Thank you for watching. We'll see you next time.